Hello, this is Chapter 9, video lecture, long-term assets, fixed and intangible assets. So we're looking at how to account for these two, how to make journal entries for these assets. So learning objective, define, classify, and count for the cost of fixed assets. Compute depreciation using the following methods: straight line, units of activity, double declining balance. Journalize disposable of fixed assets. Describe the accounting for natural resources, including the journal entry for depletion. Describe the accounting for intangible assets such as patents, copyrights, and goodwill. Describe how depreciation expense is reported on an income statement and prepare a balance sheet that includes fixed assets and intangible assets. Describe and illustrate the fixed asset turnover ratio to assess the efficiency of a company's use of its fixed assets. Describe and illustrate the accounting for the exchange of similar fixed assets. Fixed assets are long-term or relatively permanent assets such as equipment, machinery, buildings, and land. We've accounted for this before, just basically, but we're going to get into this a little more in depth. Other descriptive titles for fixed assets are plant assets or property, plant, and equipment. Fixed assets have the following characteristics. They exist physically and thus are tangible assets. They are owned and used by the company and its normal operations. They are not offered by sale as part of normal operations. Classifying costs. A cost that has been incurred may be classified as a fixed asset, an investment, or an expense. Classifying a cost involves the following steps. Step 1 is the purchased item long-lived? If yes, the item is recorded as an asset on the balance sheet, either as a fixed asset or an investment. Proceed to step 2. If no, the item is classified and recorded as an expense. Step 2 is the asset used in normal operations? If yes, the asset is classified and recorded as a fixed asset. If no, the asset is classified and recorded as an investment. So here's a diagram of it. Yes and no. For step 1, if it's yes, you move on. If it's no, it's an expense. Step 2, if it's yes, it's a fixed asset. If no, it's an investment. So items that are classified and recorded as fixed assets include land, buildings, and equipment. Such assets normally last more than a year and are used in the normal operations. Investments are long-lived assets that are not used in the normal operations and are held for future resale. Such assets are reported on the balance sheet in a section entitled Investments. Cost of acquiring fixed assets. So here's building. So here are all the fees that are attached to acquiring a building. Go through and take a look at those. Machinery as well. There's a list of expenses that are incurred. Land, those are listed there as well. These are the same as the ones in your book. Land improvements as well. So those are the lists of the costs or expenses for acquiring. Only costs necessary for preparing the fixed asset for use are included as a cost of the asset. Unnecessary costs that do not increase the asset's usefulness are recorded as an expense. These include the following: vandalism, mistaken installation, uninsured theft, damage during unpacking and installing, fines for not obtaining proper permits from governmental agencies. Here's an example. So equipment, all that went into it, $1,250 for the purchase, $600 for freight, $1,500 for installation, minus $500 due in error of installation. So the journal entry goes $13,600 on equipment, and it comes out of cash. Don't forget, a credit in cash is a decrease, so it's a credit, $13,600. So we're putting an asset as $13,600. Okay. Direct costs incurred in the construction of a fixed asset, such as labor and materials, should be capitalized as a debt to an account entitled Construction in Progress. When the construction is complete, the costs are reclassified by crediting construction in progress and debiting the proper fixed asset account, such as building. A lease is a contract for the use of an asset for a period of time. The two parties to a lease contract are as follows. The lessor is the party who owns the asset. The lessee is the party to whom the rights to use the asset are granted by the lessor. Leasing is an asset Leasing an asset has the following advantages. The leasee has access to an asset without having to spend funds or obtain financing to buy the asset. Expenses such as repair and maintenance costs may be the responsibility of the lessor. The risk of incurring additional costs because the asset becomes obsolete before the end of its useful life can be mitigated. The Financial Accounting Standards Board, FASB, and IASB recently completed a project to merge U.S. and international standards on leasing, distinguishing between finance leases and operating leases. Under both types of leases, the lessee records an asset and liability similar to having purchased the asset. However, the amount of depreciation expense and interest expense will differ for each type of lease. For short-term leases, term 12 months or less, the lessee records lease payments by obtaining rent expense and crediting cash. Regardless of this type of lease terms should be disclosed in the notes to the financial statements. Over time, fixed assets with the exception of land, lose their ability to provide services. Thus, the cost of fixed assets such as equipment and buildings should be recorded as an expense over their useful lives. Recording the cost of fixed assets as an expense is called depreciation. Because land has an unlimited life, it is not depreciated. Land actually appreciates in value for the most part. Depreciation can be caused by physical or functional factors. Physical depreciation factors include wear and tear during use or from exposure to weather. Functional depreciation factors include obsolescence and changes in customer needs that cause the asset to no longer provide services for which it was intended. Two common misunderstandings that exist about depreciation as used in accounting include: depreciation does not measure a decline in the market value of a fixed asset. Instead, depreciation is an allocation of a fixed asset's costs to expense over the asset's useful life. Thus, the book value of a fixed asset cost less accumulated depreciation usually does not agree with the asset's market value. Depreciation does not provide cash to replace fixed assets as they wear out. Three factors that determine the depreciation expense for a fixed asset are as follows: the asset's initial cost, the asset's expected useful life, the asset's estimated residual value. So the initial cost of a fixed asset is the purchase price of an asset plus all costs to obtain and ready it for use. The expected useful life of a fixed asset is the estimated length of time the asset will be used in normal operations. It is estimated at the time the asset is placed into service. Estimates of expected useful lives are available from industry trade associations. The residual value of a fixed asset is the estimated value of the asset at the end of its useful life. It is estimated at the time the asset is placed into service. Residual value is sometimes referred to as scrap value, salvage value, trade-in value. So those are all synonymous terms. The difference between a fixed asset's initial cost and its residual value is called the asset's depreciable cost. This is the asset's cost that is allocated over its useful life as depreciation expense. If a fixed asset has no residual value, then its entire cost should be allocated to depreciation. So here's an example. Initial cost is $24,000. Expected useful life is 5 years. Estimated residual value is $2,000. So initial cost minus the residual value, which will be $2,200, is depreciable cost. So year one, this is expense. Each year is, whenever you see 5, that means we would divide it by 22 divided by 5, and this each year we expense that amount out. Okay, so keep that in mind. The 3 depreciation methods used most often are as follows: straight line, units of activity, double declining balance. There's also MACRs, but we don't get into that. I don't think in this chapter. Usually that's into advanced accounting or intermediate accounting. whenever you do taxes, they do ask if you want to use straight line, double declining, or mattress. But you'll probably learn that later. It is not necessary for a company to use only one method of computing depreciation for all its fixed assets. The straight line methods provides the same amount of depreciation expense for each year for the asset's useful life. So when that diagram happened earlier, when I said 22,000 divided by 5, that's straight line depreciation. That's where it's average, and then you take that same average each year until it's fully depreciated. Here's what I'm talking about. 24,000 minus 2 divided by 5, so 4,400 for each of the 5 years. Here's this is what straight line looks at. It's 20%, 20%, 20% each year. Basically, it's an average. That's why I said average, but it's referred to as straight line rate. So here's an example: 20%, 100 divided by 5. 8 years, it will be 100% divided by 8. 25 years, 100% divided by 25. So these are the expenses if you use straight line over the expected useful life over here. So here's what happens. So for the first year, depreciation expense forklift, 4,400 goes to depreciation expense. Accumulated depreciation goes to is credited. Now keep in mind, this is a contra asset, so on the balance sheet it'll say forklift, asset, forklift, and then accumulated depreciation. 4,400 will be the sub or the contra account to forklift as an asset. So then as you go through, it'll give you a value, the market value of the asset at the time, or actually each year. Accumulated depreciation accounts are called, oh, look at this, contra asset account, a contra account, or contra asset account. This is because accumulated depreciation accounts are deducted from their related fixed asset accounts on the balance sheet. The difference between fixed asset is called the book value. So this value is the book value. The next year it'll decrease by 4,400 again. That'll be the book value the following year. So here's an example. So straight line method, depreciation expense and book value. So here's how much is depreciated each year, 4,400. Here's the book value at each year end, 19,600, 15,200, so on and so forth, until the value or the useful life or the scrap value is 2,000. Okay. Units of activity method provides the same amount of depreciation expense for each unit of the activity of the asset. Depending on the asset, the units of activity can be expressed in terms of hours, miles driven, or quantity produced. So at NAPI, they go by hours of operation on their farm, on the big tractors. So typically, those are leased though, so that there's a difference whenever equipment is leased. They're not necessarily depreciating. In essence, is what I'm saying. So the units of activity method also may also be called the units of production method or units of output method. So here's how it's calculated. Cost minus the residual value divided by total estimated units of activity. So if it's 1,000 hours, you divide by 1,000. So here's the example. 24 minus 2,000 divided by 10,000 hours. So $2.20 per hour is depreciation expense per unit. So 220 times 2,100 hours for that year or that operating or fiscal year. So $4,620 will be our depreciation expense. Again, it's just calculated or journalized the exact same way as before. The only difference is how we calculate this value, our depreciation expense. So this journal entry is the same. So year one, 2,100 hours, 1,500, 2,600, 1,800, 2,000, a total of 10,000 hours. And then once that's done, then you've completely fully expensed or fully depreciated your asset. So here's what that looks like over time. It all depends on your hours each year that you use, and then still this declines steadily. all the way until you're at 2,000 hours or $2,000. But here's what it looks like for each year. Very similar to down here as well. The bottom one is just a bar graph. Double declining balance method provides a declining period expense over the expected useful life of the asset. So here are the steps. Determine the straight line percentage using the expected useful life. 2, determine the double declining balance rate by multiplying the straight line rate from step 1 by 2. Compute the depreciation expense by multiplying the double declining balance rate from step 2 times the book value of the asset for the first year. The book value of the asset is its initial cost. So here's an example. 24,000, 5 years, residual value will be 2,000. So straight line is 20%. Double decline will be 40%. So our depreciation expense is going to be 9,600. Notice in year 1 it's 9,600. Before it was 4,400. I think it was 4,400. Yeah, it was 4,400. So keep that in mind. So you're expensing out sooner. So what this is doing is this is making your income lower. So your net income or your net profit will be lower, which sometimes you want to do that because remember, when your net income is lower, you're paying less tax. So you have to decide which method would work best. Again, for this one, for double declining, your journal entry is going to be exactly the same. Okay, keep that in mind. No matter which method you use, you still record it the same way. So here's what this looks like. And you guys will have to create tables like this in the homework. So 24,000, this is accumulated depreciation, 9,600, 15,300, 18, 2,000. Oh, hang on one second. So our depreciation for each year decreases slowly until it hits 2,000. Okay, once you get to this year, then you just kind of have to go the remaining balance and get it to 2,000, because once you go below 2,000, that's what your scrap value is, or salvage value, or residual value. Okay. When the double declining balance method is used, the estimated residual value is not considered. However, the asset should not be depreciated below its estimated value. Double declining balance method has higher depreciation in the first year of the asset's life, followed by declining depreciation amounts. For this reason, the double declining balance method is called an accelerated depreciation method. It is accelerated, okay? So here's what this looks like over time, over that 5-year period. Notice it's 40%, 40%, 40%, 40%, and it's 40% of the book value. Okay, so keep that in mind. I know that sounds crazy, but it's 40. This is calculated 40% of that. This is calculated 40% of that. This is calculated 40% of that until you can't do any more. Okay, summary of depreciation methods: straight line, years, units of activity, years, cost less residual value, declining book value, but not below residual value. Straight line, costs minus residual value divided by total units of activity. Straight line rate times 2. This is constant, this is variable, and this is declining. So whichever one you think for your organization or your own business, you decide to do that. Typically, if you're a small company or a small business, you probably just go with straight line because it takes a lot of bookkeeping to take into account the units of activity and double declining. Keep in mind, units of activity too is you use it if you have like a lot of vehicles. Okay, so that's kind of one of the things you need to take into account. I'm going to stop right here since this is going at almost 20 minutes. I'll finish the video, this chapter video lecture in the following video.